Hello everybody, welcome to a very special edition of Monday Morning Must-Knows. My name is Merlin Rothfeld. You know, in the financial markets, people talk about fear and greed and all these emotional pieces that drive markets colossally to the moon or crash, and all of a sudden people are freaking out about that. You know what? To me, it's all opportunity if I have the right plan and the right strategy in place. Now, right now, we have an opportunity in front of us, and it's called inflation. You may not know this, but as of Friday, December 10th, the Consumer Price Index numbers came out showing that inflation is running right around 6.8% year over year. When you strip out food and energy, which is extremely volatile, it's actually right around 4.9%. Now, how does this stack up with historical numbers? It's the first time in 39 years that we've seen inflation at these levels. That is a colossal peak in inflation, and I don't know if it's done. So let's take a look at some data here to put it all into perspective and see, should we be freaking out? What are the opportunities and how do we play it? When we look at this inflation chart here, this goes all the way back into the 1960s, so a long time in the financial markets. But what I want you to notice, and we'll break it down step by step, so don't worry, it might look confusing right now. What you have in blue is the Consumer Price Index. Now that's the cost of goods and services, and it takes out, in this example, food and energy, which are arguably the most volatile pieces, but we'll let the Fed have their day. This is actually from the Federal Reserve. And in red, you have the effective Fed funds rate. That's the rate that the Fed is charging other banks for money. And right now, that is less than 0.25%. On the hard red edge, you notice that that blue line is absolutely spiking. We call that going parabolic, meaning that inflation is rising very quickly. You'll also notice that that little red line there is showing a quick decline, and that's, of course, due to COVID-19. See that big drop in the Fed funds rate, and it's now pegged to zero. The meaning and the intent of that is to keep the pedal to the metal, to keep these markets fired up. Let's keep those rates low. Let's let businesses get money real cheap so they can grow and they can hire and they can expand. It's a good move. It's what they should be doing to help an economy grow. But at a certain point, you keep the gas pedal floored too long, you start to get a red line on your engine, and that engine gets overheated, and Castro GTX, your engine explodes. Going to give props to the oil company there. Now, is this an outlier? Should we freak out about this moment right now? The answer is no. You shouldn't freak out about it. You should strategize and have a plan. So let's look historically and see what the impacts of inflation rising so quickly has been on these markets in the past. Let's go all the way back here. You got a nice little black line that just showed up on your chart. That's your ceiling right now at about 5%. Now currently we're at 4.9 on CPI, stripping out food and energy, which is called core CPI. You notice in this red box, that goes all the way back into 1990. Core inflation was 5%, right? So exactly where we are right now. And the Fed funds rate was at 7.5%. 7.5%. Can you imagine what would happen to our markets right now if we were at 7.5% Fed funds rate? That means for you to get a loan for a car would probably cost you about 12%. You want to get a loan for a house, you're probably looking at 9, 10, 11%. This economy would slow down dramatically. Oh, but wait, there's more. If we go back into the 70s, and we're talking a little bit deeper into that chart, 1973 to be precise, inflation was right around 5%, core inflation, again, stripping out food and energy. The Fed funds rate was at 10%, and notice what happened in the 80s. We spiked all the way up to about 16% on the Fed funds rate. Our next one goes back into 1968. Fed funds rate spiked at about 7% when the CPI numbers jumped above 5. The point I'm trying to make here is when we have high inflation, Fed funds rate rises to accommodate that and slow things down. Well, we'll look at the solutions here in just a second. So what's causing all this? Why are we seeing such a huge spike in inflation so quickly? Well, if you look at this chart, this is what's called M1 money supply. And again, these charts are provided by the Federal Reserve of St. Louis. The M1 money supply basically tells you how much physical dollars are in cash and cash equivalent deposits at financial institutions. So let's just look at this first horizontal line right here. That red line I just drew is right around 4 trillion. That means that over the course of the history of the United States of America, all the way through 2020, we had only $4 trillion worth of physical US dollars in circulation. Now, we don't know whether that's a lot or a little, right? But what we do know is it's taken us the entire history of the United States to get to 4 trillion. Now, there's something that's kind of odd about this chart. You may notice it looks like a computer glitch. Look at the right-hand side of this chart and you see a massive spike to the upside. I'll put a red line right across the top. That is the amount of money we have increased in the past, let's call it 19 or 20 months. We are now over $20 trillion worth of M1 money supply. That's an increase of over $16 trillion in a period of less than 2 years. So let's see, it's taken us over 100 years to get to 4 trillion, and we just added in another 16 trillion in less than 2 years. Something seems wrong here. And if you take basic economics, what they tell you is when you have more money chasing the same amount of goods and services, the value of those goods and services are going to rise dramatically. You'll see a spike. I think we just saw that on the previous chart. So maybe we need some economists at the Federal Reserve, because printing that much money, very dangerous. And it's not just the Fed. We have government stimulus coming out of every corner of government right now, and there's more coming down the pipeline, which could further exacerbate this problem, which leads to what? I can't hear you. That's right, more inflation. Wait a minute. So we've got to fix this problem. So how do we fix this problem? Well, there's a couple of different things they can do. As you can see, this M1 money supply is incredibly steep. What they can do is start to remove money supply. So how do they do that? Well, they stop buying mortgage-backed securities. They stop buying treasuries. So right now, the Fed doesn't print money. They literally go to a computer. They say, we need $100 billion to buy these treasuries. And right now, they're buying $80 billion a month of treasuries and $40 billion of mortgage-backed securities. That's $120 billion a month created out of thin air to buy these products to support our market. I ask you, is the housing market doing bad? Why should they be buying mortgage-backed securities? Is the bond market doing real bad? No. Why should they be buying these securities as well? They're trying to support the market, which doesn't need support at this point. So first thing they do is start to remove money supply, which means they stop buying mortgage-backed securities and treasuries, which is propping the market up. You remove that backstop, the market now has an air of weakness to it. They retire that money, which means the M1 money supply should start to decline. Number two, okay, so we've got remove money supply, and the second biggest thing they do is they raise the Fed funds rate. Now, on December 15th, you're going to see a Fed announcement about rates. They're probably not going to raise, but the talk track may point to a not so rosy future for the financial markets, because they're going to say in 2022, we're going to raise rates a couple of times. 1, 2, I think it's going to be more than that. But they have to raise rates to slow down the economy. Hold on a second. We need a robust economy, right? The economic data is starting to show a decline, but we're seeing high inflation. This is called stagflation, where GDP and economic growth start to slow down, but inflation rises. And here's the problem with this. How do you beat it? Because if I have inflation, I need to raise rates. I need to slow down the economy. I need to pull money out of the economy, which is a stimulus. So if I do that to combat inflation, what happens to growth? It gets even worse. Oh, I can't do that. Let's say I need to start to push growth up. All right, so if I try to make growth go up, I now need to print more money so it's out there and businesses can have access to it. And I need to make it cheaper, keep that Fed funds rate at 0, which is going to do what? It's going to make inflation go higher. So we are in this very unique situation right now where it's like we're kind of proverbial damned if you do, damned if you don't type of situation. Now, what does this mean for you and me, right? Should we be freaking out? Well, let's put things in perspective with regards to growth of our portfolios over the last, let's say, 30, 40, 50 years. In this chart right here, this is of the S&P 500. What I want to do is point out a couple different spots. On the hard right edge here, you can see the most recent spike. This is because of COVID. Going to those February lows to the peak as of December 10th, you can see 115% gains. A lot of you, vast majority, probably 99% of the people watching this right now have tremendous paper profits. You are sitting on a paper pile of money. It's paper. It's not realized yet. But what if you go all the way back to 2009? You're looking at 609% gain. Wow, this is awesome. Yes, it is. But remember, markets crash, markets correct, and this is an outlier that you see in your chart right here. And to put it into perspective, I'm going to focus on 2 events that have happened in my lifetime that I remember vividly because I was actively sitting there trading those. If you go back into the 1990s, there was this thing called the internet, and all of a sudden the market soared in the late 90s into early 2000s, excuse me. From that moment, there was a very nice correction of over 50%, right around 50% in the markets. And the industry said, oh my gosh, it's now in textbooks as, remember the dot-com bubble? It was a bubble. Really? Where was that on this chart? Oh, that's this little guy over here on the left-hand side. Isn't he so cute? That was what the industry was freaking out about as the dot-com bubble. Oh, but wait, there's more. Remember the financial crisis where they said the whole system's going to collapse? That was here. That was a 57% move to the downside in our equity markets. So I ask you, if you look at this price chart, should you be afraid? Does this look normal to you? Is a 609% move to the upside with almost no pullbacks normal? Especially when we look at it in contrast to the dot-com bubble and the financial crisis. So what do we do? How do we prepare for this? Well, bottom line is, you better get educated and understand how to protect your portfolio, using things like market timing, using things like supply and demand, and coming up with a solid, concrete plan to help you protect your assets and lock in some of those colossal paper profits that you have. Does it mean you should jump ship and, I'm selling everything? No, not necessarily. For some, that might be an appropriate plan. For others, I might go out there and start using options and buying puts to hedge, or selling options against my current portfolio holdings to help generate some income and give me a little bit of insurance protection. Others might be looking to the futures markets or specific equity securities and ETFs to help capitalize on a downside move. The bottom line is, it's about education. It's about understanding what the market is throwing at you at any moment in time. And as we know, over the past hundreds or so years of the markets, they're always going to be changing. They're always going to give us opportunity to trade and to advance our portfolio to the upside. Just don't get caught off guard. Don't freak out. Don't stress. Make sure you have a plan and attack these markets.